Good evening, everyone, and welcome to tonight's live stream. I have the distinct pleasure, backed by popular demand, by the way, Scott Edgington from Qualified Financial Services. He is their resident expert on investments, tax, and actually some tax issues as well. Scott's been a veteran of financial services. How long is it, Scott? More than 25 years.
No, well, it's been a long time. 30 years, perhaps 25 years for sure.
Wow. So
Yeah.
we have the right person on the call today.
Hopefully, yeah.
Well, I appreciate you you being able to be available for tonight's live stream. As you know, we go live every Wednesday at 7 o'clock, barring any like snowstorms or hurricanes.
Yeah, precisely. Big storm here this week.
Yeah. So tonight we're going to be talking about, I'll put that slide up again. We're going to be talking about everything you need to know about tax-free savings account. We're actually going to be explaining it not high level, but we're going to like right from the very beginning of understanding what it is, what kind of eligible investments are put in there, how to treat withdrawals, how that works out, how do you contribute, what is that confusing area around contributing and withdrawals and being offside, and I know it's really
Sure.
but we're going to dive right into it, and we've got I think some very good slides to illustrate some of the confusing points, and we're just going to go through them. And I have basically put some questions on there for you so you can explain to everybody how tax-free savings account.
Okay, sounds great.
If anyone, by the way, if anyone is tuning into my live stream for the first time, we go live every Wednesday, but to a larger point, these videos are held on our YouTube channel at Aaron Wealth Management. If you just Google on YouTube, Aaron Wealth Management, and you'll see our videos. And I think there's about 50 videos there now on just about every topic: financial planning, life insurance, estate planning, how to minimize your tax, helping business owners as well. So it's a great channel. So if you haven't subscribed yet, please go ahead and follow and subscribe and share this with everybody you think needs to see. So let's just dive right into this. I am gonna just shower you with questions today.
Alrighty.
And let's see. Let's start off with the first ones here, and let's talk about this a little bit about tax-free savings account. Can you speak to some of the points there when it was started?
Of course, yeah. Well, thanks for having me, David. We'll get to dive right in here, as you say. Tax-free savings accounts started in 2009. Another way for Canadians to save for retirement or for other financial needs into the future. I think only Canada and Australia have sort of things designated exactly like this. If you look at savings plans like this around the world, I think one of the disservices actually that was undertaken by the government was referring to them as accounts. I think it's probably more appropriate to refer to them as a plan, like we do an RRSP, like a registered retirement savings plan, or a retirement income fund, like a RIF. I think it does create some confusion from time to time, people thinking that they have to go and open an account at a bank or something. That certainly isn't the case. Yourself and every financial advisor can offer TFSAs to their clients. So that was, don't want to go too deep into that, but I wish they were called tax-free savings plans. It would probably be a better name for it.
But Scott, is that around this confusion of in the very beginning when people first opened tax-free savings account? At least I know it's your experience and mine. People would have high interest savings in there as their investment.
Yeah, exactly. Yeah. They were treated like checking accounts or something like a daily interest account where people were putting money in and taking money out, and really wasn't the intention. The idea with a TFSA is longer term investing and taking advantage of the year upon year tax-free compounding, unlike like a non-registered investment where there will be some tax every year, or a GIC, there will be some tax every year. Inside of a TFSA, that tax savings gets compounded every year as well. So it's a great long-term investment vehicle that people take advantage of, not every Canadian, but a lot of people do take advantage of it.
Right. Okay, so a couple more points. I think
Yeah.
let's talk about eligible. I think we talked about 18 years of age.
Yeah, you have to be 18 to start accumulating TFSA room. And I believe we have a little table coming up about that.
Yeah.
But you have to be 18 years old to start to build TFSA contribution room. The nice thing about it is, unlike an RSP where you have to have earned income to create RSP room, we get TFSA room solely for being taxpayers and residents in Canada, as long as we're 18 and over.
Right.
And to your last point about eligible investments, a lot of things can go into a TFSA. The list is the same as the list for RRSPs. And my simple rule for remembering what's eligible, it's things that can be valued on a daily basis, like stocks and bonds and gold and silver, precious metals, derivative contracts, but something that you can go and look every day and say what it's worth, which kind of makes sense, because if you don't know what it's worth, how do you know how much of your contribution room you've used? Yeah. So you can't put in a piece of art or an old watch or an old piece of jewelry. That doesn't work because you don't know what it's worth.
So a tradable security.
Yeah. I think it's a daily valuation is probably like my rule of thumb. Like if I know, if you ask me what this thing is worth today, and I can go to a stock market or some reputable source and they're going to say it's worth $10 a share, then it's worth $10 a share.
Right. Okay. Okay. So
not my collectible car or something. You can't hide one of those in a TFSA.
Yeah, I'm so glad we're touching that point, because it's one of the things that I've noticed in managing and doing portfolio reviews. People ask, could you do a complimentary portfolio review? And I look and I see that they have high interest savings, and they might have an RSP and they'll have various investments. And I say, why don't you invest similarly to what you're doing? And they just didn't know. They weren't aware of it. So
makes perfect sense. Yeah.
Okay, so let's talk about the tax-free savings account as being a tax-sheltered plan. I suppose that's where the name comes from, tax-free. Let's talk to these points here. Income or growth is not subject to tax.
Absolutely. So no growth in maybe use a stock as an example. If you purchased a stock.
How's that?
Oh, I wish I'd purchased that back in 2013. And my TFSA would all be tax-free.
So using an example, Scott, if you had purchased Tesla in 2013, let's say 2014, when it was about $20 a share, and it's closed today at $9.95. So, I mean, 1,000 shares, that's $1 million in your portfolio. If someone had purchased that in the tax-free savings and just held on to it, and then decided to sell that today, so they went from 1,000 shares at $20,000 investment to pretty much $1 million now in their portfolio. Do they have to pay any income tax if they take that out?
No, they wouldn't. There's only one thing you have to be careful with. And if person is a frequent trader, like a day trader, and they're using like they're doing that inside of their TFSA, if the Canadian Revenue Agency will look at that and say, is that really an investment that someone is saving to buy a house or for retirement income, or is this really an investment business that they're running? Exactly. And if they deem it to be an investment business, then all of the growth is taxable as income. It's 100% taxable. So I would, like your example, that's just one trade, 7 or 8 years ago.
Yeah, buy and hold.
There's no way you could deem that to be a business. But if I was buying Tesla in and out over that period of time, making multiple trades a week or a month, they would start to question, if they were to audit the account, they would question, like, what are you really doing here?
Sure. But that,
GameStop is a good example as well. That's stock that so-called meme stock that when it was December 2020, it kind of got rolling from $4 up to $400. If you'd only made one transaction in that would be great. You'd have all that tax-free growth.
Sure. So the main message is, if something like this happens, it doesn't have to be that much growth. But if you have if your portfolio has grown significantly and you want to pull money out, there's no tax implications for you to do that.
No, none at all. You don't report it as income, which may be a future bullet in our discussion tonight. But the nice thing about it not being reported as income is it won't affect any benefits a person may be receiving. Like, in Ontario, there's ODSP. If you were only to have TFSA income, you'd never have to worry about an OAS clawback, an old age security clawback, because you don't report it, so it doesn't get counted as income. And there's other things. I guess there's the age benefit as well that we get at age 65. That could be unaffected if your income was coming out of a TFSA. So you can strategically use it to make sure that your net income falls below a certain line, but your actual income could be much higher. It's just that you don't have to report it.
Exactly. Okay. We've covered eligible investments. So, we're going to now talk about income earned and withdrawals do not affect any our income tax.
Oh yeah, there's that bullet. Yeah, great.
So that's what we were talking about. Now, some people ask me, and I wanted to save this for you, but how are U.S. dividend investments, so the U.S. dividend income, treated if you get that inside of a tax-free savings account?
Well, foreign dividends don't enjoy the dividend tax credit that dividends that are from Canadian corporations get when we receive those. So it's just, if it was outside of a TFSA, just in a non-registered account, it's just dollar for dollar. $1 of U.S. dividend income is $1 of income when you report it on your taxes. But if it's inside TFSA, of course, there's no tax, because all the growth or the income that is generated plus the growth is tax-free inside the TFSA. One thing we were talking about earlier, I think people should remember or be aware of the fact that if people plan to move to the U.S. at some time in the future, they're snowbirds, they want to retire in Florida or something like that, the U.S. does not recognize TFSAs. They don't, for all essential purposes, don't know what one is. So money that's withdrawn from a TFSA could become subject to U.S. taxation. So you have to be careful there. So if someone has never had a TFSA and in the next couple of years is planning a move to the U.S. and going to become a U.S. taxpayer, starting a TFSA now probably doesn't make a lot of sense.
Right.
Or if another thing they could do is, if they knew this was going to happen, they could cash out their TFSA while they're still a Canadian resident and then just take the cash with them when they move down to the States.
I asked that question because a lot of people who decided to trade stocks, and the NASDAQ was so incredibly hot in 2010, they traded a lot of NASDAQ stocks, and so the dividend income is a problem in their portfolio. Okay, so speaking of that, let's talk about capital losses. How is that treated? And specifically can you speak to this idea of, if you've bought whether it's a mutual fund, a segregated fund, if you've got a stock and you've got a significant capital loss, maybe even to zero, God forbid that happens. But speak to, is it recoverable? And then what about, how does that affect the person's room contribution?
Sure. There's actually an interesting sort of sidebar I can share as well in this situation. But one of the properties of a TFSA is you can take money out of it, and you can take your principal plus growth, and in the following tax year, to be safe, you can put that amount back in. So you never ever lose the contribution room. And in fact, it can be enhanced if you put, like using your Tesla example, if you started at $20,000 and it went to $1 million, and then you took that $1 million out, in the following calendar year, you actually could recontribute $1 million into your TFSA. So you never lose the principal plus the growth. You just there's a bit of a time delay, but you don't really lose that contribution room. The wrinkle, though, is, let's say that happened in reverse, that you bought $1 million worth of Tesla and it went down to $20,000 and you decided to take it out. It's unfortunately too bad, so sad. If you take $20,000 out, you can only put $20,000 back in. So that losses, you don't get to boost your contribution room back up by the amount of money you've lost. It only works on the plus side, not on the negative side.
Well, that's an interesting. Let's see if we can get us both back in this. Here, there, I think.
There you go. Yeah.
That's the interesting dynamic here. Someone who is investing and they have a capital loss. Unlike in a non-registered plan, you can't. In a non-registered plan, if you had a capital loss, that'd be beneficial for you, but
Yeah,
to carry it forward and offset it in the next year. But the idea here is that that loss is, if it's an unrecoverable loss,
yes,
that it's lost forever.
yeah. And I actually helped a client one time that had over contributed,
Mhm.
and the whatever they had purchased for their TFSA had actually gone down to such a point that they didn't have enough money to pay the penalties and everything. So that I actually phoned the CRA about this, and they actually said they would offer leniency to this person if the person said, "Look, it was over an over contributed position, but now it's way below it, and I can't afford the penalty." And they actually worked out a deal with this taxpayer,
Nice.
so that they could sort things out. Yeah, that surprisingly, I think if you get through to the right person at CRA, they're actually quite cooperative and helpful.
We gotta get their number and put it on the internet.
Yeah, it's probably very small, like in fine print, that number.
Okay, I take an investment loan and I
Mhm.
decide to take that because let's say I haven't never contributed to a
Mhm.
tax-free savings account
Yep.
is, and let's say I take the maximum for
Sure.
2022, could I just put that in there and then deduct the interest on the loan?
Unfortunately, the answer is no to that. Another sort of rule of thumb with the CRA is they generally only try to give one tax benefit per concept or scheme or plan, whatever you want to use. So the big tax break with the TFSA obviously is the tax-free accumulation and disposition of the assets. They're not going to let you borrow money and deduct the interest and get that tax advantage.
Right.
So that the interest on a loan for the investment purposes is not deductible if the money's used for a TFSA, whereas if it's used for an eligible non-registered investment, you can deduct the cost of borrowing from right off the top of your income, as a matter of fact. It's
So
just a deduction.
I'm going to put a slide up here in a second, just talk.
Mhm.
It illustrates the sort of the advantage, the competitive advantage of a tax-free savings account against a non-registered account. One of the things, and I didn't put it in a slide, and I just thought that if you could speak to this, and that is not so much about who should use a TFSA, because I know everyone should have a
Mhm.
tax savings account. But if the person has a low income, so think about low income earners,
Mhm.
they're in the lowest tax bracket, and like, where does it make more sense for someone to use a tax-free savings account or an RRSP, given the fact that they probably don't have enough money to do both?
Yeah. Well, given sort of the same time horizon for let's say that whichever person, they both have the same time horizon. A lower income person, it kind of makes more sense to do a TFSA, and because there will be their top tax rate will probably be low because they're not making a lot of money, like a student or someone just starting to work or a part-time employee, something like that. They could start, saving money in their TFSA. They're still building RSP contribution room if they're receiving T4 income. And then there could come a day when, they get promoted or they go to full-time employment or something happens and their income goes up meaningfully and they're moved into a much higher top bracket. Then they would have all this unused RSP room that they could go and really clobber their net income for that year or over a couple of years. And one strategy, of course, is to do that when it makes sense. And then when you get your tax refund, just fill up your TFSA with your tax refund.
So anyone listening to this right now, we have some people who are live stream. Thanks for everyone who are on the live stream with us.
Yeah.
In the replay of this, because I get a lot of people watching the videos afterwards. What you just said, Scott, is such a clear example of why people should use an advisor. Because
Yeah.
you just dropped a nugget on the table that is so valuable for anyone who is, and it doesn't necessarily have to be somebody who is, as you say, let's say an entry level position, just working part time, and their income is low, and that within that first tax bracket. But it also could be someone that, as we've seen over the last year and a half, who has been, um, their job is no longer available to them, and they have a low income here.
Mm-hmm.
So they know that when all this switches around and we go back to full employment, their income is going to spike and they're going to have a higher income. So anyone watching this today, please rewind that 30 seconds or a minute and re-listen to what Scott just said about the idea of saving that opportunity of allowing your contribution room to accumulate and use it when your income goes up. I'm so happy you said that, because it's probably one of the most savviest things that an advisor can help a client out in.
Yeah.
Well done.
Yeah, and I think another, if I can maybe put this towards the end of someone's working life,
Yeah.
they may also want to consider TFSAs at that point, because if they're, I don't know, let's say 5 years away from when they expect to retire, making RSP contributions at that time may not be that advantageous, because the money will not get to be in the RSP long enough to kind of overcome the future taxation that it's going to face when it comes out.
Right.
So, or if a person has most of their retirement income is going to be from RIFs and a pension, do they really want to add more taxable money into that pot? A TFSA may make more sense for those folks. And with that, like, I know you use planning software. With planning software, you can just scenario test it. Is it better to put the money in the TFSA, or is it better to put the money in my RSP? Yeah. Which one generates more future income? And it's right. It's in black and white in front of you.
Exactly. We go through a lot of financial plans, making sure we're getting the best outcome for our clients.
Yeah.
Okay, this is an interesting slide that I wanted to share with everyone, because it speaks to this idea of the advantage of a tax-free savings account over a non-registered plan. So this idea that if you never use a tax-free savings account, or maybe you have, but you just haven't been deliberate in the way that you use it, you open it and you've still got quite a bit of money in a non-registered account, and dollar for dollar. So what this is really showing is, and it's not even taking advantage of the full contribution room, if a 25-year-old was to deposit from age 25, $5,000 per year, right up until age 65, and get 5% of the money. So it's same dollar amount going in, same rate of return to a non-registered investment and a tax-free savings account. You can see it's a 48.6% advantage to have that same money in a tax-free savings account. So it's a powerful example of just having your money in the wrong account. You can have almost 50% less money.
Yeah. I think, it goes like one of the overarching things about planning is, I'm sure perhaps you put this question to clients, as do I will say to people, like, what do you think your biggest expense is over the course of your life? And many people say, well, it's probably my mortgage or my children's education. And those are all good things, but your biggest expense over your lifetime is taxes, and everything you can do to minimize the amount of taxes you pay. And I'm not saying tax avoidance or doing anything shady, just doing things in accordance with what CRA provides within their guidelines. It can make a huge difference. And that slide is a great example of that. And that's non-registered money, where that actually does get favorable taxation, because only half of capital gains are taxable at the moment. And there'd be some interest and dividends perhaps in that example. But the tax is our biggest expense. And that's the thing we should focus in on when we're planning, because that's not so much that would you rather have $1 million TFSA set up for your retirement or $1 million RSP? Well, I think most people would get it straight away. Well, I want the TFSA because it's all going to be tax free when I pull it out. And that to me, you were kidding at the beginning about all the tax stuff, but I think if you have a handle on, and you don't have to be knee deep in the Tax Act, but just these principles that apply to individual saving can make a huge difference in someone's lifestyle in the future.
I don't have this particular slide, but one of the things that I focus in on, and that is sharing with people this. It's not an idea; it's the math, and that is, a lot of people, and we've got a couple of comments and questions from a couple of viewers. And Mac Daddy, I'm going to put if it's all right with you, I'm going to put your comment on the screen. The same with you, Shane, if you don't mind.
Oh yes, yeah.
But one of the things that I share with my clients, and that is, and especially when I do reviews with people, and that is the amount of tax your state is going to have. A lot of people are investing, and sometimes they invest the same amount of money every month. They do it for whatever reason, but it may not be because they're actually trying to hit a target. They're just, this is what I put in this last year and the year before, and I know how much I'm getting back in my return. So it's not really linked to a retirement goal. And so when I say, well, look, what if we did a financial plan that addressed the taxation in your state? Because how do you feel about giving $300,000 check to Revenue Canada at your passing?
Yes,
I mean, it's a serious amount of money that people have to give up at the end of their life. So I'm just going to share this comment here. Mac Daddy, welcome aboard tonight. Thank you so much for tuning in. I appreciate it. Mac Daddy saying that is exactly what I'm doing. I have a plan to retire in 3 years, and I'm now maxing out the free space I have in my tax-free savings account. Hopefully, it will be maxed out, meaning it'll have 0 room by 2025. And thanks for saying that. And by the way, Mac Daddy, I'm actually going to be at the very end. I know Scott kind of, we think so much alike. You're saying these things. It's one of the final slides in the presentation is how does a tax-free savings account fit into your retirement planning strategy? And so we're going to dive into that as well. And we got another comment here from Shane. Shane, thanks very much for tuning in tonight. Welcome aboard, and thanks for giving your time so generously today to watch the video. You guys are awesome. I just typed a long message asking about when we should do a tax-free savings account versus an RSP. They're in their 50s with all retirement savings, and you answer my question 100%.
That's great.
Is that a common thing? Do you see, Scott, that people focus on paying down their mortgage and investing in RSPs, and they kind of didn't really pay attention to tax-free savings?
Yeah, I think just, relatively, like RSPs have been around a lot longer, and I think it's maybe part of it is human psychology, because when you make an RSP contribution, there's that instant gratification that you get a refund. And I think a lot of people invest in RSPs, not for retirement planning, but for the refund that's going to show up in 2 or 3 months after the person files their taxes. But it's a good idea to have an overall look at the hierarchy of RSPs, TFSAs, non-registered savings, and just think of it like a pie. How big is each slice? And that the size of those slices is going to vary based on the point in someone's sort of financial life.
Yeah.
And it's just dialing those things in together with the aim of reducing the amount in dollars you're going to pay in taxes over the course of your life. Is one way to kind of look at that mixture.
I'm going to try something. I don't know if I can actually do this. I've never done this live, so my goodness, I hope it shows up right. A window, yes. Okay. Woohoo! Can everybody see?
Oh, there we go. Yeah, great.
Okay, so what this is showing is the retirement timeline. I put this up in other YouTube videos.
Yeah.
So, everybody go check out, retirement planning and so on in my YouTube channel. But this is a good illustration that you've been speaking to, specifically about this idea of when you retire. We might as well just jump to this and we can talk about it.
Yeah.
We don't have to follow any planned agenda here, but where does a tax-free savings account fit into retirement planning? So when you look at this, you see a normal retirement age is 65. And then you can, age 60, you can retire and start getting your CPP at age 60. And what I put in here specifically is this idea of what if someone had intended to take their government benefits, CPP and OAS, at age 65, but they retire at age 60, and those 2 red columns there represent the gap where they have no money to support their annual income. And this is exactly where a tax-free savings account can be used, very useful for you.
Sure. Yeah. Just a general rule of thumb, I wouldn't, every case is unique, but the idea is the stuff that is going to be taxed at the highest rate is probably best to let it sit there as long as possible.
Exactly.
So to spend your non-registered and your TFSA money before at 71, we have to start taking out our RSPs.
Yeah.
But prior to that, if you don't need the money, most plans I've helped with, it appears that if you can kick that down the road as far as possible, it's probably better to spend the most tax efficient stuff first. And that you wind up paying the least amount of taxes over the course of your life. Everyone is different, but I think that's a decent rule of thumb to follow.
Well done. So I hope some of that helps answer the question for Shane, and also not Daddy, because it's an important consideration. Okay, so we're back to, I think we finished all these questions we did. Let's jump to this one. Let's talk about the difference between a tax receipt.
Oh, okay, of course, yeah. For myself, the way I kind of remember them is I think of a TFSA is really an RSP that's been stood on its head. So if we remember the sort of the basics of RSPs, we create contribution room through working at work, up to 18% of our salary or our reported income or an annual maximum that the government sets out. And then when we make contributions to it, that money is taken off the top of our income and our taxes owing can be reduced. And when we reach age 71, the CRA says, we've been so nice to you, letting you grow this money tax deferred and get all those deductions. Now you've got to start taking it out, and we're going to fully tax it when it comes out. Now, on the other side of the coin, we have the TFSA, where there is no deduction for putting money in, but you don't have to be working to create room. Just as a resident, you get room as long as you're 18 years old, and you keep getting more and more room as every calendar year goes by. And then when money comes out of the TFSA, it isn't taxed. And that includes the growth. So no deduction on the way in, no tax on the way out with a TFSA, and an RSP is just the opposite. Tax deduction on the way in, fully taxable on the way out. And one more thing to contemplate is RSPs, their withdrawals become mandatory once we reach age 71. With TFSAs, as long as you're walking the earth in Canada, you can continue to contribute, and there's no obligation to take any money out. So even though, I'm kind of maybe going to cross something I just said a few seconds ago, but what I find working with advisors and their clients is people continue to save in their TFSAs regardless of their age. Like an 80-year-old, an 85-year-old, every year will want to put their $6,000 away in their TFSA. And I think that's just more maybe investor psychology, that the thought of doing something where there's no taxation is very appealing. And people just keep building up their TFSAs, which is kind of interesting. But I see it all the time. Older folks will want to spend down their RSPs and their non-registered money before they touch their TFSAs, which from a pure logic standpoint may not make the most sense, but from an emotional standpoint, it seems to be what everyone is doing. I don't know if you see that too, David.
I see it from the point of view of especially people who are not at 65. Some people downsize at 65.
Yeah.
But seniors who largely, because it's much more difficult for them to maintain their residence they've been in, or the malls, going up the stairs, the large yards, that type of thing, that they downsize, and then they've got a lot of, and they might either buy a condo or just rent a condo.
Yeah. And
they've got now a fairly sizable non-registered portfolio because of the sale of their principal residence.
Mm-hmm.
That event, as you know, is a non-taxable event for many of those people.
Yeah.
So what do? Well, if they hadn't used a tax-free savings account, they would have immediately filled it up.
Just fill it up, yeah.
And every year they're gonna push 6,000.
Yeah.
And speaking of that, we'll just put that slide up right now. The contribution rooms.
Oh, right. Yeah, great. Yeah, so we were talking about beginning in 2009, and here are the assuming someone was 18 or over in 2009, they would have accumulated all these this room over the years too. In 2022 now, the lifetime limit is 81,500. But let's suppose someone was born in or turned 18 in 2016, for example. then they would only have the contribution room that was generated in the sort of the rightmost column on the screen there. So I'm not sure what that adds up to, but that would be the most they could contribute. And then in 2023, they would get another $6,000 or an indexed amount above $6,000 and keep going forward. And it's not prorated. So someone that's born on December 31st, 2016, they would, or turned 18 December 31st, 2016, they would have the full, in this example, $5,500 of room for that year.
Right, exactly. So what you're really saying is someone who was 18 at 2016 couldn't go back to 2009.
No.
Before they were 18 and use that room that everyone else was able to use. So that makes sense.
Yeah, and the other little detail is if someone is a non-resident for a year or a couple of years, they don't accumulate the room that is credited that year. You have to be a resident of Canada to get the room.
That went to university out of Canada.
Yep, exactly. It's funny you bring that up because I helped with a case where someone went to study in Hong Kong and they mistakenly made a contribution and went over, and the money had to be withdrawn, or they were going to pay that 1% penalty per month on the over contribution.
Right, makes sense. Okay, so back to our questions. Withdrawals from an RSP, you said withdrawals from RSP cannot be replaced in age 71.
Yeah, that's an important point too. That when we were speaking earlier, if you take money out of a TFSA, you can put that full amount back in the following calendar year. If you take money out of your RSP, you can't put it back into an RSP unless you have the RSP room. Yeah. If you stop creating room or you've used it all up, you're scuppered. There's nothing you can do.
Exactly. And by the way, we've got another question here, but if anyone is trying to figure out how do I know if I've got room, well, you go to your.
Oh, yes. Yeah. Yeah.
Now, something about the CRA account, you'll notice I put in the middle there. It's not always up to date. It really depends on if you filed your income tax. So if you're looking right now, we're in January, and maybe you haven't filed your income tax yet. And so, because you know a lot of the tax receipts haven't come in yet, and you're looking and you go on My CRA, it may not show that your full limit is there because you haven't filed your income tax yet. So it's just something you got to be aware of.
Yeah, CRA will, maybe another sort of subtle advantage of a TFSA because they know how much you've contributed, and therefore they'll just add the $6,000 and update their system. But in order to change your RSP room and so on, you have to file because they need your T4s to see how much RSP room was created in that tax year or in that calendar year. So you're right. Things have to be filed in order for those numbers to get updated.
Exactly. We got a question from, this is from Mac Daddy. Daddy. Yeah. A question about RSP withdrawal. So different subject, but we'll cover it anyway tonight.
Yeah.
Does it have to be made as a RIF to do a withdrawal, or can I wind it down in the form of an RSP completely, say from age 55 to 70 to 0, and then it just goes away? So maybe we should cover off, just as a side note, how somebody withdraws out of an RSP. What are the ways that someone can do that?
Yeah, people can make ad hoc withdrawals from an RSP. There's no problem with that. If someone needs money to, put a new roof on their house or buy a furnace or something, you can request the money. The holder of the RSP is obliged to apply withholding tax. And if you're interested, the scale is the first $5,000, 10% gets withheld. And then between 5 and 15, 20% gets withheld. And 15 plus 30% gets withheld by the issuer of the RSP.
So just to clear that up, the holder means what you really mean to say is if you have your money at a financial institution, the financial institution is the holder of your account. Right.
They're obliged. They'd be breaking the law if they didn't withhold that tax when you made the withdrawal. So you could do that. You could take money out just from time to time. Maybe once a year, take an ad hoc withdrawal and start to wind up your RSPs. If it becomes systematic, it's probably wise just to convert the RSP to a RIF at that time. There's no minimum age to be a RIF holder. There will be a minimum that's required each year, but at age 50, the minimum is 1/40, 2% or something, 2.5%. So there's probably be in excess of the minimum. Some people do this to reduce taxable income in retirement. And they may not have a lot of income themselves while they're doing it, so they can get a lot of the money out at a very low tax rate. That's certainly a reasonable strategy to do something like that.
You and I both dealt with this earlier this week, and that was for a client of mine. Actually, we did the numbers, and we're just looking at someone who was turning 65 next year, in the beginning of next year, and there was like a gap where they needed some capital today, meaning the whole year.
Yeah.
So the idea was, does she RIF now, or do we go ahead and just do withdrawals? Withdrawals in this calendar year, which is what we opted to do, where we just withdrew $5,000 per month for her.
And I think most of the holder, the company that's managing it, if it becomes systematic, they're going to ask you to turn it into a RIF. They don't want to have a systematic withdrawals coming from an RSP. Ad hoc is fine, but in my experience, if you start going, I want this every month, they're going to say, well, let's just convert it to a RIF. And one thing to remember is you don't have to convert the entire amount. You could, if you had $100,000, you could open a RIF with $50,000 of it. There's no harm in doing that.
Yeah.
And that would sort of get the cash flow going.
Exactly. Because in her case, she doesn't actually need that RIF income at age 65 because she has other assets like the CPP and old age security at the time. So that was very useful for her. I'm going to go to the next slide, Shane. I'll see if I can get to your question. Shane has another question for us, but I'll see if we can get to it. Okay. TFSA, we were just talking about that. Can I withdraw TFSA? Can I replace it? Let's talk about this very confusing idea of TFSA withdrawals. Let's say I'm going to present an idea for you, okay?
Yeah.
Let's say I have $10,000 in my tax-free savings account right now as of January, January 19. And I need the money. I need all of it now. Can I take all my $10,000 out right now?
You certainly can. Yes, of course you can.
Next, in the spring, I'm selling my house and I'm going to have $10,000 of it. Well, actually, let's put it a different way. I just withdrew $100,000 out of my tax-free savings account just now, and then I sell my house in the spring, and I want to contribute that money back. Can I do that?
The fine details are that this person would also have acquired $6,000 of room for 2022.
Yeah.
So if they took out $100,000, they would still have $6,000 of unused room. So in theory, they could put $6,000 back in, but they would have to wait and put $94,000 back in 2023.
So that is the real confusing part for a lot of people, is they think that they can do a withdrawal and then just put it right back right away because they got.
Yeah, that unfortunately it's deemed, if you go over whatever your outstanding limit is or your current limit, it's deemed an overcontribution for that year.
So if you have, so just as we clear this up, if you have zero contribution room in your TFSA, that means you have put in your maximum amount since 2009.
Yeah.
And you go to withdraw $1, $2, $3, doesn't matter if it was 10,000.
You're right.
You really can't put that back in this calendar year.
No.
You have to wait to the next year.
January 1st the next year. Yeah.
So January 1st the next year, you get your $6,000 that you can put in, plus the amount that you withdrew in this calendar year.
Precisely. Yeah, that's exactly how it works.
So it just gets a little confusing for some people.
It's the unused room part that kind of makes it just puts a wrinkle into it.
Yes.
But working with clients, I generally just say, if you take it out, we're going to have to wait till next year to put it back in. And by and large, that kind of is the way most of it works.
So that goes to the last point here on this slide, and that is, if I have a need for money next year, so I know the next year I'm going to be buying a new car, or next year my child's going off to university or whatever the case. Next year, I want to replace the dock at the cottage. Should I be doing that withdrawal this year versus withdrawing it next year?
Yeah, I certainly, I agree with that sort of idea. I might say to the client, if you have this pending expense then in 2023, let's set some money aside from your TFSA in December this year. You don't have to do it today because we've got almost 12 months to go, but in December 2022, let's pull that money out, because then depending on circumstances in 2023, it actually could be recontributed. If you didn't use it or you got a bonus from work or something, there was some extra money around. That's probably the way I would do it. Just take it out right at the end of the year, because you literally could take it out December 31st and put it back in, January 2nd.
And Shane, if you're still on the call and you just want to type in the chat, Shane was saying, just to clear up the withdrawals. Interestingly, we're explaining it, and I think we've totally confused some of the people. Is that the issue, Shane? Was that around what?
So confusing, yeah.
The confusing part about how much you can put back? Yep. I love it. Okay, so let's just clear this up. What would you say to begin? The easiest way to explain this would be if you had zero contribution room available to you.
Then any money you take out you'll have to wait till next year to redeposit it in the TFSA.
So right now, the maximum contribution room available for 2022 is $81,500.
Yes, yeah.
So let's say I had contributed everything, $81,500 last year. No, this year I have.
You've already done the transaction
right now, and then at some point I wanted to withdraw $5,000. You're free and clear to take the $5,000 out.
Yes, of course.
The issue is really around the government saying how much money you're allowed to contribute each year, and that
Shane's going to be very confused after I say this next thing. But when TFSAs were first available, you were actually allowed to contribute the money back in the same calendar year. But CRA ran into a systems problem that they didn't know where this money was going. So they had to wait till year end to do sort of a reconciliation with all the TFSA holders or issuers. And then there's this big reconciliation is done. And then they know, like Scott took out 81.5, he can put 81.5 back in 2023. So I think the good rule of thumb is if you take it out this year, you're going to have to wait to put it back in until next year.
Yeah. It's a good rule of thumb, and I just like to make it more confusing for them. But the idea is if you had unused contribution room, so let's say the limit is $81,500 for 2020, and let's say I only had $10,000 in my TFSA.
Yes, yeah.
And I decided that I wanted to make a contribution of $6,000 this year. So that's my annual contribution room that is afforded to you with a TFSA. If I want to go ahead now and just withdraw $10,000, again, we've said no problem, you can do the withdrawal. But if I had the money available, Shane's going to make sense now. If a couple months later I got that $10,000 back again, could I put it back into a TFSA?
Sure. Yeah, because you have 71.5 of unused room.
Exactly. Yeah.
Yeah.
So that's very good. Ivan, thanks for being on the call. So we'll put this up on the.
Yeah.
Ivan from British Columbia.
Yes.
How you doing, Ivan?
Yeah, Ivan's. That's right.
If I withdraw $15,000 December 22, can I repay $15,000 plus the $6,000 in 2023? And the answer is
yes. Ivan's been listening. Thank you very much.
That's right. That's right. Okay, so well done, guys. Thanks for your contribution to tonight's video. Let's look at where are we. TFSA withdrawals. Yeah. Okay. Moving on to, let's talk about how TFSA fits into your retirement income source.
Sure. Yeah. Well, it's a
So,
great, it's nice how this all weaves together. It's a great source of retirement income, partially because you can take it out and use it in retirement. And then the following year, if you have extra money around in retirement, you could put it right back into a TFSA and let it continue to grow tax-free. So it works very well that way. And as we were saying earlier, because withdrawals from a TFSA aren't reported as income, they have no impact on any income tested benefit, OAS, the age credit, and I said earlier, like ODSP. There could be some disability benefits that people receive that are based on income, and it wouldn't affect those. So it's a very useful tool that way as well. So it can play a big part in retirement planning for sure. And it's a good way too, if you can probably only do this once, but if there's a year you want to kick something down the road, you could always take money from, rather than taking money out of your non-registered account, you could take it out of your TFSA and use it. And then the following year, when there's that space available, you would take the money from the non-registered account and just fill your TFSA back up. And that kind of moves the tax bill 1 year down the road as well. So it's a very useful tool. And because there's no age limit for withdrawals, that's very useful, unlike an RSP that has to become a RIF. And the contributions can continue until, your last breath. It's very useful.
in fact, TFSAs, when they first came out in 2009, a lot of people laughed at that and said, "What am I going to do with this?"
With $5,000, yeah.
But because of the cumulative effect of contributing, especially if you're married, that combined having you and your spouse,
Sure, yeah.
that's a considerable amount of money by the time.
Yeah, what is it? 160, $3,000 now in a household. It's a lot of contribution room.
So it gives a lot of breathing space for a lot of couples.
Yeah, and I would go back to I don't know if it's one of your bullets, but that chart you had where the non-registered versus the TFSA. The one thing to contemplate too, if you plan to just buy and hold in your TFSA for some time, depending on your investment risk tolerance, you may want to put the riskier investments into your TFSA. Like if that's put your equity mutual funds or your equity segregated funds in the TFSA, because one of the tenets of investing is the more risk you take, the greater the reward should be. So if riskier investments can produce a bigger reward, wouldn't you want to shelter a bigger reward from taxation? So sometimes we will put the less risky investments perhaps in a non-registered or an RSP and put the riskier ones in someone's TFSA to kind of optimize that tax-free nature, the tax deferral, the compounding tax saving. I don't know if we got to talk about that, but that's something to think about. So your Tesla stock is a great example, right? It's a perfect example of using it.
Yeah, because back then, a lot of people, probably didn't have a real good idea as to how is this going to catch on, and also I know when it first came out, this idea going up against the major car companies was, David and Goliath type of thing. So it was okay. Let's look at some other considerations around.
Okay.
What happens to a tax-free savings account at death?
Okay, so there's a couple of situations, really only two. Someone's partner can be the beneficiary of a TFSA, and the value of the deceased TFSA can go into the TFSA of the survivor. The survivor doesn't need contribution room in order for that to happen. CRA calls it an exempt deposit. So that can happen in the event that when there is a spouse around and you name the spouse as the beneficiary. If it was a single person, of course, it would be like everything else. When someone passes away, CRA deems that people sold everything the second before they died, and any tax generated as a result of those dispositions, the estate has to deal with those. But because this is a TFSA, if you sold it the moment before you died, there's no tax because it's a TFSA. The only wrinkle is that if, while the estate is being processed, any income earned by the TFSA is taxable to the estate. It's just that lag. But by and large, it's going to be tax-free either to someone's spouse, to someone's children. But it's like a principal residence. It really just goes transfers. The legacy just goes or the bequest goes tax-free to whomever.
And that's why we suggest using segregated funds to help that transfer of the asset in the most efficient,
very efficient way. Yeah. Yes.
Without going too far, but banking products go through a probate period, and in some cases be delayed.
Yeah, certainly. Like the sort of breaks down into two camps. All registered products, which TFSAs fall under that category, they have beneficiaries and they avoid the probate process. Where segregated funds really shine as non-registered money. Because with a segregated fund, which is an insurance company's mutual fund, just a simple way to describe it, you don't have beneficiaries on non-registered accounts anywhere other than with segregated funds. And by naming beneficiaries, as David, you're just saying, if you have a beneficiary, payment of a death benefit goes immediately to the beneficiary and skips the probate process. And just be biased here because I'm in Ontario, but in Ontario, probate property that's probated attracts a 1.5% charge. It takes forever to get a will probated these days. And in Ontario, I can't speak for the other provinces because it's not universal, but in Ontario, when an asset isn't probated, it doesn't go on the public record. So it's done confidentially as well. And if you remember our old former mayor, his estate still isn't settled. Rob Ford's estate is still unsettled. And I know he passed away in 2017.
Well, it took, just in my own personal experience, took my aunt's estate 5 years to settle.
Yeah. If there's contesting anything in the estate, it's going to take ages to settle.
Yeah,
ages.
We should leave that we should do
maybe another night. We can talk about that.
Talk about marriage breakdown. We have a few minutes left, and then we're going to let's talk about marriage breakdown and divorce.
Sure, that's pretty straightforward. It's a community property, and so it will be split based on the terms of the separation agreement. And again, it's an exempt deposit. So if it's deemed that one spouse is going to move some money to the ex-spouse just as part of the separation agreement, they can make that contribution into the other spouse's TFSA, and they don't need the room to do that.
So yes, exactly. So one of the situations, just to make it really clear, and that is when a couple gets divorced and someone has to give money to one spouse has to give money to the other spouse. And if they take a withdrawal out of the tax-free savings account and then give it to the other spouse as a check, and that if that spouse doesn't have room in their tax-free savings account, it's not.
Yeah, they lose the benefit of it. Yeah.
So in marriage, there's a form that is in a divorce. There's a form that is used to be able to transfer from a tax-free savings account into the other spouse, even if they don't have any contribution room available.
It's exactly the case, and the same is true for RRSPs.
Right, exactly. What about successor holder versus beneficiary in a tax-free savings account?
That's an interesting question as well, which I would kind of break down between segregated funds and everything else. Everything else, I would say successor holder, it has to be a spouse, is probably the right way to do it. That way, when the first spouse passes away, the other spouse just takes over. But in the segregated fund world, where there could be guarantees that come into effect when someone passes away, it's probably better to have the spouse as the beneficiary, and then the spouse would receive the proceeds of the death claim from the TFSA, and then they can make what's called an exempt deposit into their own TFSA because the source of the money is from a deceased spouse. And I can even bore you with the form number. It is RC 240. And that lets a person make an exempt deposit into their own TFSA with proceeds from a deceased spouse's account.
So the idea that if someone is in a segregated fund and they didn't have it set up as a successor holder, but had it as a beneficiary, they're still able to
They're still able to do it. Yeah. Yeah. And I've actually, I've helped a couple of clients do it, and it's a very straightforward, simple form.
Yeah.
And all CRA is doing in the background, they're just making sure that they don't record that as an over contribution.
Very good. Well, that is all the slides we have for this evening. Everyone that was on the call, thank you so much for participating. All the questions we had, this was awesome. We love hearing questions.
Yes, yeah.
It's so much better when, you know, people who are watching have their own ideas and thoughts and saying, hey, could you answer this? Especially if it wasn't on the agenda, we're happy to squeeze it in there. I always end my every presentation with these two things. Scott, as you well know, I'm big on doing financial planning. It's of your planning decisions before you commit to them. It's so important. So if someone is thinking of opening a tax-free savings account, or if you haven't, or if you already have one, remember that the most important thing to do besides doing that is to get a written financial plan done. Instead of you just putting money aside every month, because that's what you did every other month, why don't you think of it from a goal-based planning point of view and really start executing on those goals, those savings targets, which are so important. And the last thing, I want to say thank you, Scott, for being so generous with your time tonight. It was, again, another great presentation, lots of questions. You're one of the few people that I'm being asked over and over again, when are you going to have Scott on? When are you going to have Scott on again?
Oh, that's great. That's great.
Really pleased. Thank you so much for.
Yeah, it's my pleasure.
And everyone, again, thanks so much for dropping by. Remember to like and share, follow wherever you are, whether you're on Facebook, LinkedIn, or on YouTube. Please remember to share and follow this content. And if you want to see any other of the videos we've done, go to the YouTube channel, because LinkedIn doesn't store all the videos. Only it's done on YouTube. And we'll see you live next Wednesday. And thanks again, Scott, for tuning in. Great information again.
Okay. Thanks very much. And thanks to everyone that joined in. That's super.
Well done. Thanks again. And good night, everyone.